Hello, welcome to episode 4 of Dhanmantra. Today we want to explore about different asset classes available to the modern investor. In the ancient times, people used to buy cattle, land and gold or silver to accumulate wealth. In today's modern world, modern economy, many of these assets are replaced by different ones. Let's find out by our guests.
So, before we talk about different asset classes, I just want to talk about what an investment means and what an asset means. So, basically, asset is something that you own and you benefit from. When you talk about an investment, it is something which will give you a return in terms of capital appreciation. As the time grows, it will gain some value, and that capital appreciation you will pocket that, or that return can be derived in terms of dividend, interest, or anything which is beyond the capital return of it. So when we talk about investment classes, we can categorize them into different 5 to 7 categories. It could be debt, equity, real estate, commodities like gold, silver, other precious metals, this precious gems. So these are the commodities. And we can also talk about luxury assets like wine, fine art, etc. So basically all these kind of investment assets have different characteristics and their functioning differs from one another. So that is why they are categorized into different segments. Now, how the return is derived from these investment assets basically depend upon their risk and reward, the demand and supply, and the utility around these assets.
How do we differentiate between real assets and financial assets?
All these investment assets can be broadly classified into 2 categories: financial assets and real assets. Financial assets are something which derive their value from a contractual claim. Like debt is a relationship between a borrower and a lender. Equity is something depending on the percentage of ownership in an entity or a corporation. You can define as a minority shareholder or a majority shareholder. But when we talk about physical assets, they are real, they are tangible. You can see them, in front of your eyes. There can be real estate, gold, other precious gem, commodities, and cash. So these are the different assets.
With the advancement of human civilization, the enforcement of law and order has improved. Hence, the market for financial products like debt and equity has increased multi-fold. So, what is the investment in debt and equity products? Let's explore further.
So debt is basically like I spoke before, it's a relationship between a borrower or lender. Someone borrows the money and someone lends the money. So that is where a debt comes into equation, because the borrower is liable to pay the lender the principal along with some fixed rate of return depending on terms and conditions signed up. So equity basically depends upon the percentage of ownership that you have in the entity. You could be a showrunner in that, so basically operating a business, that is also a form of equity. Or you could be supporting an idea or a business as a private equity or a venture capitalist, helping them to grow. That is also another form of equity you could hold. Or you could buy shares and be a shareholder in a listed company and be a percentage shareholder, like a 1%, 5%, etc.
We see a tendency in a lot of people to hold cash. We ask our guest, is cash really an investment or just an asset?
So I think that cash is an asset because you own it and benefit from it, but it cannot be defined as an investment asset because there are no returns generated when you keep your cash under the pillow or in your hand, in your wallet. So cash is an asset, but it's not an investment asset.
Now we know the different asset classes available for modern investor. But what are the expected returns in these asset classes?
So different asset classes will offer different returns basically based on their functioning and their risk reward characteristics. When we talk about debt is basically an obligation where the borrower has to repay the principal. So there is a certain amount of principal security offered, and that is why it gives you fixed rate of return. It could be as low as what we give to the bank in the form of savings bank account we operate. It gives us 4%, or it could be as high yielding debt, which would give you something between 15 to 18%. Now, when we talk about debt, there are two fundamental risks attached to it. One is the credit risk, which you are basically taking on the issuer. So there is a default risk attached. That means you won't get your principal back, or it could be interest rate risk. Now, current market scenario, what interests are operating and what interest your debt is paying, varying depending on how the market interest rate will be in the future. Your valuation for that particular debt could also change. So I would say it could range between as low as 4 to 6% to as high as 15 to 18% in debt. But so equities basically are kind of an ownership in an entity. So there are two things to it. First is when you are giving your money for an ownership title, there is a risk of that the company will be no more into existence. So you may not even get your invested capital back. So for that compensation, they give you higher return. Plus, equity by default has a higher growth because you're participating in the future earnings of the company. So equities can give you to as much as 8% to as high as 25%. Now, when I'm talking about 8%, I'm talking about big companies, large cap, giant cap companies, which have trillions of revenues, thousands of employees catering. So they are basically stable companies. So they'll give you 8% growth or 10% growth because of their enormous size. Now, when I'm talking about 25%, I'm talking about small caps, which are like teenagers with high potential but a high probability of making mistakes also. So they are gradually going up the ladder of learning curve, and they are learning how to make their businesses as big as what large cap companies are. So this is the varying equity returns that you get. Now, when you talk about commodities like gold, silver, other precious gems, we are seeing the return of 6 to 12% on it. Now, when we talk about 6 to 12%, so when the economies are doing good, so gold is not that much into demand. Other financial assets are. So that is where the low returns comes into picture. When we're talking about high returns, we are talking about when the economies are not doing good and people find a safe haven in gold because of its tangibility. And gold has been a standard currency even when the financial markets were not into existence. So they have some affinity which investors feel safe with. So in varying markets, in volatile markets, you see gold will give you better return, or they have a potential to give you better return. Now, when you talk about luxury assets like fine art and wine, there have been a decay where art has given you as low as 6%, but wine has given you 13 to 14%. Now, these assets are basically something like hobby investing for ultra HNIs. Like they are doing it just for the fun of it, or they want to pass on that legacy to their next generation. So, from that perspective, we are talking about fine art and wine. Those are luxury assets. It could be also yachts and other things. So I think they are not for the common man. They are only for the UHNIs or the ultra NHs as we talk, because of the quantum of investment is pretty high and the risk involved is also very high.
It's been said that one should not put all the eggs in one basket. So, in the today's investment world, what kind of investment breakup do we see across different investment classes?
Hi. Ideal breakup in different asset classes depends on two very important parameters. One is what is the minimum amount you have to put in there, and second is your risk appetite. So if we see at a common level, at a general level, the public's behavior is that they put around 30 to 50% of their entire wealth into assets like real estate. The basic reason behind that is the high cost of real estate. So if you want to own one house, it can easily be around a 3 BHK, let's say for example, comes around 1 CR to 1.5 CR. Then you want to own a plot of land in a good area, then it could be easily of around 40-50 lakhs. Now, if you own, let's say 2-3 plots and 2-3 houses like that, then around 4 to 5 CR generally gets tied up into real estate. Then second comes gold. Gold people generally buy in terms of jewelry and they get gifted, let's say during marriage and different occasions. So around 10% people hold in their total asset, total wealth in terms of gold and silver, sometimes precious gems also. Then third comes debt. In India, the behavior is that people mostly invest, like put their money in savings account and FD and post office and PPF. So the larger part again goes into debt products. And last actually comes into equity. Mostly what we have seen is that people don't invest more than 20-30% of their entire wealth into direct equity, which may or may not be good, again depending upon their goals, time frame and what they want to achieve with their wealth. But what we suggest, again, let's say if you want to achieve some goal and you are finding that your wealth is actually falling short of it, then again equity, like equity mutual funds, are a good investment asset where you might generate higher returns over a long period of time. Then as we come towards ultra HNI clients, then they might have some assets which are very expensive, some piece of arts, or again like coming to wine. So yes, in those parlance, or let's say in those with those investors, sometimes 10 to 20% of wealth is actually tied up into such assets also.
How easy it is to buy such investment assets in today's world? Should we buy just on the basis of ease of investment?
Ease of investment in any asset class is a very important factor to consider. Investment in any asset class depends on actually two factors. One is that what is the minimum amount you have to put in, and secondly, how complex is the product. So ease of investment, when we talk about, it's easiest to, you can just put your money in your savings bank account. You can just open in a day, in an hour or so, and you can put your cash in it, and you can start getting 4% from day one. But when we talk about complex assets, like where ultra HNI invest, like for example wine or art, there you require a lot of help, a lot of study and research, and you need people who can assure you of the validity of the correct type of wine or a correct type of art, which may or may not grow in to a huge value after some period of time. So ease of investment, let's say for example, as I told you, it's very easy to hold cash, or you can just put your money in savings account. Then we come to investment in debt, is again very easy. Then debt, like for example, you want to make an FD, you want to start something in post office or something like that. Then slightly complexity comes when you come towards structured debt. Structured debt may or may not be secured. When it is, let's say, not secured, then you have to be very, very diligent, like where you are putting your money, in which venture, or whom you are giving your money to. Then the complexity increases when it comes towards equity, because to understand equity means like you have to understand the business. So when you are putting your money in equity, let's say even if you are buying one single share of any company, let's say for example Titan. Everybody knows Titan for Tanishq jewelry or fast track watches, but we have to understand what exact business Titan is doing and what are the expected returns this quarter, next quarter, and then this year, next year, for 5 to 10 years. Until and unless you develop, or let's say if you have a person who has that skill set, who can guide you to invest your money in correct venture, I think personally you should refrain for investing into equity, because again it becomes a complex art. And then the most complex is become, let's say, is the what we call it, art and wine, and in between somewhere comes gold. It is again very easy. You can just go ahead and buy the gold coin, because gold coin is again very easy to put in, and the cost of investing in gold coin is really less. I mean, it costs around really 3% to 4%, or maybe slightly higher than that in some cases. Whereas if you invest in jewelry, the making charges and other charges total combined could be as high as 35 to 40%. So people should be slightly wary if you are considering to put money in jewelry as an investment. Now, again, real estate can also be a slightly complex investment avenue, because you have to do a thorough research, because we have to find out, like, the people who are offering you the real estate venture, how trustworthy they are, then what are the legalities involved in that, are the title clear or not. Sometimes people check as far as they go for 100 years title, or sometimes 3 generation back title. Once these things are clear, then you might also have to see if there is any litigation attached to it, or the government is coming up with something regarding that project or in that area. So again, investing in real estate is slightly more complex than investing in a debt fund.
So we learned today about the investment classes for a modern investor. Also, that an investor should diligently research about his needs and the investment product before making any decision. Team Dhanmantra hopes that our efforts help you in making better investment decisions and create a lot of wealth. Thank you.